Morning friends, today's topic is changing trend in research on entrepreneurship with a special reference to banking. Myself Dr. Pranamdhar, Professor and former Head, Department of Commerce and Management, West Bengal State University. So, to start with, banking is an essentially meant for services trade, commerce and industry. The banks are more often than not occupied in the two major types of services, namely mobilization of deposits from the particular local vicinities and ancillary services to depositors. Number two is lending of funds to a wide array of business, industrial, economic and personal activities of entrepreneurs like traders, merchants and industrialists to secure maximum comeback on their advances. And lastly, as a catalyst, pass on the finances of the government or support agencies to a wide array of business, industrial, economic and personal activities of entrepreneurs. Now, the most common complaint in different parts of the country is that about the lack of finance affecting the entrepreneurship development. Very often, however, by this is meant the lack of equity capital as well as credit, since no distinction is made between the two, although capital must be owned by the entrepreneur while credit is borrowed in the shape of long-term and short-term loans. The former to finance fixed assets and the latter to defray current expenses on stock, wages and the like. In India, the craftsman or the small industrialist may start business with some saved capital of his own. Gradually, an entrepreneurial skill, energy and business ability adds to capital out of the profits. Depending on his attitude and creditworthiness, industrial and business entrepreneur borrows from the friends and relatives and may even enjoy trade credit on materials and goods from suppliers and distributors if he is honest and reliable enough. In the process, since beginning of his business enterprise, he needs help from the bank. Now, banks are now ahead even in financing initial capital, which is known as also seed capital, to entrepreneurs from its own funds or the funds of the government, that is district industrial center or the development corporation. Now in this stage the role of banks is very important, and we often hear that entrepreneurs are not getting adequate funds from the banks, or they are not having the adequate training to start a new entrepreneurship or a startup. So there is a knowledge gap, and in this post-COVID scenario, lots of new avenues will be opened, right from online business, online trading and other online education and other small and medium form of entrepreneurship, which will require the bank support, and different innovations are there in banking. An entrepreneur, if he wants to join an e-bank or e-business, then also need to know something about this banking research and banking innovations. Now, if we go through the priorities of the market, especially in banking sector in 2020, there are lots of things done, like developing a customer-centric business model, optimizing distribution, simplifying business and operating models, obtaining an information advantage and enabling innovation and the capabilities required to foster it. Now, there are certain impacts of global micro trends on retail banking, because retail banking is much more popular among all of us, and this includes demographic changes, technological changes, social and behavioral change. Then there is risk related and connectivity related changes, rise of state directed capitalism and war for natural resources. Now, banks have moved towards some solution oriented integrated operations which will be winners in 2020. Before talking any more about banking, we must talk about the Indian economy, which has strong fundamentals like strong GDP growth, strong export and strong forex reserves. Now, there is a diversified composition altogether, but also a robust growth, which shows the service sector, which has the projected growth of 7.3%, industry is of 5.5% and agriculture is of 10.7%, and the real GDP growth projected although before this pandemic was 7.4%. Now, which are the drivers of this growth? First one is services, which includes IT, BPO, financial services including banking, entertainment, media, travel and tourism, and industry, which includes strong domestic demand, improving competitiveness and export trust, and agriculture, which includes favorable climate conditions with good monsoon, modernization of agriculture, which includes scale and farming methods. Then roads, we have a well construction of golden quadrilateral and north, south, east, west corridors, 13,000 kilometers long, which is the world's largest single highway project, and boosting demand for steel, cement, commercial vehicles. We have a industry base of basic telephone subscriber base of 39.9 million, growing at an average rate of 23% over the last 7 years. Cellular subscriber base of 11.7 million, growing at an average rate of 88% over the last 6 years. Positive impact on efficiency of farms and service exports. Then we have power. Within power sector, there are certain missteps have constrained the development in this sector, but now being corrected through policy initiatives. That is like the Electricity Act passed by the Parliament, a new focus on creating capacities as well as enhancing transmission and distribution efficiency. We have urban infrastructure, that is need for urban rejuvenation like housing, roads, utilities, etc. Local bodies in several cities taking initiatives in this area. Now, the changing demographic profile can also be a very important part of discussion, because there is high proportion of younger working population which is driving towards this growth. Now, we are also experiencing the robust household savings pattern, which moves from 10.1% to up to in 1970-71 now up to 36%, and in this graph we have seen it's almost 22.5%. So there is a robust household savings growth, which is a very important significant percentage of GDP. Now, there are also large inflows of foreign currency. There are strong external position, including forex reserves and external debt. There are enhanced corporate competitiveness, and the above developments are the results of a decade of reform which focuses on globalization and opening up of the economy, thrust on export-led growth, deregulation to encourage technology and capital flows, integration with international finance markets, and there are some key reform measures taken by the government, which includes the lowering of tariff barriers and liberalized imports, full convertibility of the rupee on current account, permitting domestic companies to access foreign capital markets, and substantial liberalization of previously restricted investments. Now there is a dramatic growth of services sector, which is over 50% of GDP, significant contributor to exports, and restructuring of manufacturing sector also over the past few decades. Even in 1990s, where the capitalizing on domestic demand, mid to late 1990s, where restructuring to achieve world-class efficiency, and in 2000 onwards, articulation of international competitiveness. Now, after a decade of change and evolution, we can divide the Indian economy into three periods, and especially financial sector, that is pre-reform, the 1990s, and today. In Indian economy, we can talk about in pre-reform period extensive regulation, focus on industrial sector, and in 1990s liberalization, globalization, structural change in services, and in today's context, resilient industry, buoyant services sector, and specifically in financial sector. In pre-reform period, there was highly segmented public sector dominance, and in 1990s we experienced opening up of various subsectors, private sector participation, and in today, diversified financial groups and globally benchmarked financial sector. So financial sector is mirroring macroeconomic change. Now, straight come to the banking sector today. It is characterized by four factors. One is depth, which include country-wide coverage, large number of players, increasingly sophisticated financial markets. Then diversification, which includes emergence of integrated players, diversified capital deployment, and leveraging synergies. Third one is technology, which includes increasing use of technology in operations, poised to expand and deepen technology usage. And last one is regulation. We have the banking sector with robust regulatory system aligned to international standards and efficient monetary management. Now the banking sector's snapshot. It has a size of total assets of $335 billion US dollars, total deposits of $279 billion US dollars, and total number of banks include over 290 scheduled commercial banks. Public sector bank is 27, private sector is new 9 and old 24, foreign banks is 37, and over 190 regional rural banks. And regarding branch network, we have over 66,000 branches, among which the public sector is 46,000, private sector is 5,500, foreign is 190, and regional rural banking is having a base of 14,400. Now there are some structural issues. First one is non-performing asset. There is legacy system, very low level of technology. Then seller's market mindset, which includes low level of innovation in products and services, limited responsiveness to customers' needs. And we can say that Indian banking sector has responded to these structural issues by adopting certain strategic imperatives. Now, how the legacy issues addressed? It includes challenges of changing competitive environment, like small and unviable pre-liberalization units, large investments post-liberalization impacted by global commodity cycles and high interest rates, then supportive legal and regulatory changes, which include setting up of debt recovery tribunals and enactment of SURFACE Act, reducing delays in enforcement of security and creating effective legal deferent, corporate debt structuring forum for restructuring viable companies, and enabling framework for asset construction companies. Lastly, proactive approach to resolution and increase in provisioning levels in the system. Now, with significant success in resolution, the net NPA level is somehow lowered or managed. And then technology. Technology adoption is a big challenge for the banks, and if we take the example of only one bank, ICICI Bank, we see that in 2000 figure and 2003 figure there is a difference. In 2000 figure the branches were 94% and it has reduced to 28% to branch transactions in 2003. What about ATMs? Only 3% ATMs were used in 2000. Now it is 51%. Internet usage was only 2% in 2000, and it has become 10% now. And regarding call center, it was only 1% in 2000, which is increased or enhanced to 11% in 2003. Now you see retail credit opportunity. There is a penetration, but which is very low, obviously currently low, with growth driven by strong fundamentals. Now there are some retail credit drivers like changing demographic profile, which includes middle and high income households, increased from 11.6 million in fiscal year 1995 to 25.7 million in fiscal year 2002. Then there is a declining retail loan interest rates, which includes the interest rates on residential mortgages, which have reduced by 7% over the last 4 years. And there is increasing availability. That means entry of banks has led to increased competition and coverage, and increasing usage of technology further enhancing reach and accessibility. Now this is the retail market size, which has grown over the years, and now it is having a CAGR of 31%. And there is the summary of the changing profile of corporate banking now, which includes the changes in corporate focus, improving efficiency, better asset utilization and financial management, limited new capacity creation, increasing disintermediation in top tier segment. And however, several opportunities for banks includes technology-driven fee-based services, treasury and risk management products, facilitating resource raising by corporates through syndication, securitization and market making, and new approaches to SME lending, which include sophisticated banking services and scientific portfolio construction and management. Now, regarding financial services potential, specifically about insurance, the opening of this sector provides a major opportunity for financial services players. Now, the international Indian bank opportunity, the Indian diaspora, the emergence of Indian multinationals and resultant economic flows have created a new opportunity. This is the new orientation among the banks. We can easily distinguish between the traditional and the current phases. Traditional where the public sector dominance, and now it is the private sector dominance. Traditional or public sector dominance were characterized by sale products, product research, what will sell, product sales and profitability targets, product specialist groups, introduce new offerings every few years or months, and branch banking, and lastly focus on customer acquisition. Now the orientation has completely changed. It includes meet customers' needs, customer research, what does the customer want, customer segment sales and profitability targets, customer owners, customer specific new offerings every week or day, customer convenience, and deepen the relationship. Now, the relationship between technology and banking. If we see that between banking and technology, there are some tasks common to both, which is information storage, processing, and transmission. Now, this is the growth curve, and we see that it starts with mass transaction and items processing, then pervasive branch network, then global operations, then complex credit calculations, then innovative risk management. There are many benefits of this technology, which includes increased operational efficiency, profitability and productivity, superior customer base, multiple channel, real-time transaction processing, better cross-selling ability, improved management and accountability, efficient non-performing asset management and risk management, minimal transaction cost, and improved financial analysis capabilities. Now there are certain focus aspects on commercial banking, which are CBS or core banking, electronic banking, any branch banking, CRM, MIS and internet, ATMs, POS terminals and cash dispenser, card management, document management, resource management and risk management. Now, the financial technology infrastructure of banks includes the data center to host servers for CBS, ATM, internet banking, back office application, email services, security systems and disaster recovery. Now here in banking, technology has become a differentiator. Technology is indeed a differentiator not only in terms of competitive advantage but also in terms of administrative and back-end processes. But due to rapid technology deployment in Indian banking sector, the haves and have-not gap is all set to narrow quickly. You see, there is a technology differentiation which spreads gradually from innovation to laggards, and there is a question arises, how long a differentiator? Then technology be enough a differentiator? Any new technology or technology-enabled process can act as a differentiator or a competitive edge for some level of time. After that time, the technology still has to be adopted as a necessity and as a cost of doing business. Thanks to shortening technology life cycles, it would be short-sighted to assume that technology would be a long differentiator, or rather long-term differentiator. For long-term differentiation, elements of technology as a differentiator should be scalability and flexibility, efficient utilization or management, process enabling, utility to customer, and support skills. Now some issues are always there with the customers, not only employees, there are also problems from the customer too when a new technology arrives. The major challenges are comfort levels. Okay, we are good, we don't want to move or change. Then there are certain myths about the security and trust issues, convenience factor, and getting rid of myths, and migration from existing to new systems, and changing the habits issue is also there. You see, there are certain POS terminal and cash dispenser issue, and these issues must relate to a technology which must be well conversant with the customer orientation. Similar case is also true in case of electronic banking, ATM and branch banking. Now, in case of technology acquisition, inappropriate technology purchases can be the root of all problems. The bank management here has to give thought to the utilization rate, avoid knee-jerk reactions, and be impartial in technology decisions, understand where the solution will fit and where it won't, assess the strength and weakness of solution and seek answer to are we ready for it. Then you see, technology for sustained differentiation has two sides. One side is having goal definition, integrated business and technology goals, solution features, vendor selection, business process reengineering, change management. And the other side is having efficient utilization, customer utility, technology management, support functions, maintenance, backups and disaster recovery, scalability and flexibility, learning and evolution. Now, regulation and supervision, the challenge. There is a challenge for technology regarding new markets, products, services, delivery channels, opening up of a market for risks or derivatives, challenge of financing, technology firms and IT innovation, all have implications for the stability of banks and of the economy. Now, there are certain opportunities also. These include regulators have new tools, focus of all recent financial sector reforms, emergence of non-intrusive focused supervision with a view to prevent frauds and disturbances to financial stability. Now, RBI has responded in a very good manner in the banking supervision, like including off-site supervision and monitoring, which includes OSMOS, COSMOS, UBD-SOFT, Credit Information Bureau and all that. Now this technology has transformed the conduct of the Payment and Settlement System in terms of Payment and Settlement System Act 2014 and 2017, then set the stage for an unprecedented growth in financial activity across the globe, rendered more vulnerable the domestic payment system and financial stability to international shocks, and making the conduct of monetary policy more complex and prone to implementation and operational risks. Now that there are certain opportunities also, the proliferation of IT has also set the stage for improving and managing risks in payment system, electronic trading systems, DVP or BVP, RTGS, secured netting systems, the growth of the central counterparty, continuous linked settlement, and these are the different pillars of the IT and payment and settlement systems. You could easily see all the features, all the initiatives taken by the RBI in Payment and Settlement System Act enactment and its implementation. Now, in spite of having all these implementation, there are some issues. Less than 10% of failures are due to technological snags. Most are due to poor management and implementation, like the resistance to change, overlooking process, re-engineering, project management, dedicated project teams, change management policies, people skill and training, basic infrastructure like telecom, power, etc., security, privacy and confidentiality, legal and regulatory issues. Now there are certain prerequisites for technology. One is human resource empowerment, next one is business process engineering, and third one is planning for disasters. Now when we are planning for disasters, it includes increased operational risk and business continuity planning. Now, there are certain HR related issues, like large employee base, largely untrained, training scope and methodology, VRS to balance costs, break-even, downsizing, bring your own blood, campus recruitment, redefining and designing jobs, and many more. Now there is a training, and more training needs. All these developments call for extensive and continuous training. Current and future technology implementations call for at least 20% of officers specialized in IT. hence need to specially skilled people. This is very much important for banking entrepreneurs. There should be a mix of system administrators, application managers and technological managers. Security is about a very important concern, and strong security measures plus disaster recovery are very much essential. There is need for authentication of e-banking customers and accountability for e-banking transactions. There should be a segregation of duties, proper authorization controls, etc. Physical security measures, then disaster management and disaster recovery sites. If we talk about risks, there are lots of risks, starting from country default risk, then there is prepayment risk, contract risk, extrapolation risk, and many more. Then how to ensure security? It has four facets like respond, access, protect and detect. It starts with detect, then respond, then access and then protect. Then some solutions are also there for risk assessment, audit, gap analysis, training, policy and procedure development and implementation. This transformation till date is okay, but if we move to the global banking innovation landscape, now there are two new dimensions. We have 4,000 years of internal innovation of banks since 2000 BC, and there are certain fintech companies which are providing support to banks. The 2008 crisis interestingly brought about a change in the nature of banking innovations after 4,000 years of typically internal developments, and the 6 igniting trains of fintech revolution has emerged. By January 2010, the circumstances were given for a rapid change of paradigm, and in January 2011, the flagship of fintech companies, TransferWise and other mobile banking apps have arrived. There are 6 igniting trains of the fintech revolution, like number 1, rising legal regulatory pressure, then rising financial regulatory pressure, then mass presence of 3 fairly new technologies: smartphones, high-speed internet and social media. Then number 4 is emergence of a new customer behavior pattern. The customer is known as millennials. Who are the millennials? They are best described by 3 key things that define their values: mobility, transparency and instant access. Next, 5th is very important, need for strategic renewal from within. And lastly, loss of trust from outside. So it gives birth to the fintech community, which includes fintech revolution, fintech ecosystem, incubators and Gen Y, known as millennials again. Now we have moved from external factors to in-bank innovation. There is upward shift in the intensity of in-bank innovations. There are new units in old banks, new jobs, new technology and legacy systems. This will help the entrepreneurs to become e-bankers and m-bankers in future. The main purposes of banking innovations are to become more customer-centric, to grow, to attract new customers, to increase revenue, to create the ethos of being innovative, building an innovative image, to pilot, test, experiment, create prototypes, to reduce churn, to increase loyalty, to cut costs, to raise productivity, to make processes more efficient. Now if you see the banking applications of USA, right from Movin, then in Europe, like money transfer service, peer-to-peer known as TransferWise. Then in Asia, if we see the China, Hong Kong, Japan and many more countries, they use the M-Pesa and money forward as the solution. Then if we go to Africa, it has used and it is using M-Pesa. Then in Australia it's Nimble. So if we move to the global banking innovation innovatives and initiatives, we see that lots of things, and there is a big issue like innovation versus regulation. It has 6 facets. Number 1 is first key aspect of complexity. Second key aspect of complexity is dynamism. Third key aspect of complexity is comprehension gaps. Fourth key aspect of complexity is the heavy building blocks or of the wall of overregulation. Fifth key aspect of complexity is the little explored risk management aspects of financial innovations. So there are major issues towards innovations in banking research like technology related issues, people or HR related issues, that is reskilling is needed, monetary systems, efficient telecommunication and infrastructure to drive banking on real-time basis, risk management and physical security, customer grievance redressal including ombudsman scheme, bank assurance, forex management by banks, investment management by banks, depository management by banks, financial inclusion initiative by banks, and these are the issues which the entrepreneurs have to address, and in each and every issue the entrepreneurs, if they start their own startup, especially reskilling and security issues and insurance issues, there will be new research in business innovation and business entrepreneurship. So the future will be not more of the same. We need to be ready for the future. Thank you all. Thank you for your patient hearing.